Hello everyone. Growth stock has been dropping a lot recently. However, for those strong companies, they can still grow no matter at what kind of environment. In this video, I will talk about the next Amazon, Electronic Arts, and Square Enix combined. This is an internet giant in Southeast Asia, found in Singapore. It's developed its business into three parts: digital entertainment, e-commerce, and fintech. Please watch the whole video to find out. By the way, since I provide information for free, please show your love by like, comment, and subscribe this channel to make this channel grow. Okay, let us begin. In the past year, this company's stock price rose from $41 to a maximum of $280, an increase of 6 times. It announced the latest financial report data on March 2nd. With the help of the pandemic, the growth in 2020 is very bright. The 2021 guidance given by the revenue is very good. I am not speculating here. Instead, I use some data to dig out some underlying things and give the latest analysis report. Below, we will conduct specific analysis according to these three parts of business. First, let's look at the revenue of the digital entertainment segment. Its active user increased 72% for the last 5 quarters. Its revenue increased 72% year over year to $690 million, mainly due to the Free Fire game's extraordinary performance at that time. Free Fire has become the #1 game with the highest revenue in South America and Southeast Asia for 6 consecutive quarters. The most commendable thing is that this game has become the top product in the US market and ranked 10th in American iOS best-selling games days. Its e-commerce division, Shopee, also performed well. Shopee's GMV in 2020 accounts for 57% of the entire Southeast Asian e-commerce market. The supremacy of the e-commerce platform in Southeast Asia has confirmed that its revenue has surged 178% to reach $840 million. Its e-commerce division, Shopee, also performed well. Shopee's GMV in 2020 accounts for 57% of the entire Southeast Asian e-commerce market. The supremacy of the e-commerce platform in Southeast Asia has confirmed that its revenue has surged 178% to reach $840 million. The growth of consumption has accelerated throughout the pandemic and is currently maintaining rapid development thanks to the advancement of globalization. It has developed impressively in Brazil. Shopee's platform in Brazil, which currently provides cross-border purchase from Asia, already serves more monthly active users in the country than Amazon. The pandemic accelerates the penetration and development of e-commerce. Even though the speed will slow down afterwards, it is still an incremental market. Online retail accounts for just 1% of Southeast Asia total retail sales, compared with about 6 to 8% in Europe and North America. This indicates plenty of growth for Shopee going forward. Now, Shopee is about to enter Indonesian food delivery market. It has recruited and trained local food delivery drivers. The Southeast Asian food delivery market reached $11.19 billion in 2020, and Indonesia is the largest one. Indonesia's food delivery market has been controlled by GrabFood and Gojek for a long time. Jakarta is one of the key battlefields, so you can still expect Shopee keep on growing. The loss in 2020 is greater than before. but the gross margin has begun to improve from 27.8% to 30.8%. This good trend should continue. As times go by, the company's profitability will improve with the scale of its core business. For the digital financial services, the revenue increased by 660% year-over-year to $24 billion. Its mobile wallet payment volume and payment users increased significantly. It has also expanded partnership with Google. It is executing more growth initiatives. It acquired a Hong Kong-based capital management company and established a new investment department to expand the financial business. It plans to expand its investment portfolio with a $1 billion investment in the next few years. It is one of the 4 players that will grant digital banking license in Singapore. It also acquired Indonesia's bank BKI, which are indications of a bigger ambition to expand its digital banking footprints to the rest of Southeast Asia. The above are all good aspects of the company, but viewers who watch my channel should know that we should also look at the flaws in the company. Let us also look at a specific analysis below. Although the company's revenue growth is excellent, the bottom level growth relies on a single game, and only the digital entertainment segments remain profitable. In short, it relies entirely on the Free Fire games to subsidize the expansion of other unprofitable business. This is very stressful for this old battle game. Investor needs to think about how long it can last with one game. However, it is working hard to develop other games and relying on major shareholder Tencent. There is still a lot of room to expand the game portfolio and continue to support the e-commerce department. Looking ahead to 2021, the company predicts that the growth rate of digital entertainment revenue will be 38.1%. It looks good, but it is significantly slower than the 80% growth rate in 2020. The company's high valuation is the biggest risk. Let's compare Tesla and perhaps everyone will have a more intuitive feeling. The current estimate is about 29 times the revenue in 2020 and 16 times the estimated sales this year. In contrast, Tesla indicators are about 21 times and 14 times respectively. However, this internet company has not had a quarter with profit. The analysts expect that it will not achieve profitability in the next 2 years. However, if the company can maintain high growth in the future, it can make the income of the company reach a reasonable level. But with the incomplete guidance in 2021, in addition to the decline in the growth rate of the above game business, it's expected that e-commerce revenue will grow by about 112%, which also marks a comparison with 2020. 160% of the growth rate will decelerate. The digital financial department is currently still in the investment stage. The company is working hard to make its product to become a popular payment platform. However, there are many competitors around, so it needs to sacrifice profits in order to compete for more market shares. In addition, it did not provide any additional guidance, which makes it difficult to judge whether it can continue to use Free Fire's games profits to offset the losses in its e-commerce and digital financial sectors. The company also relies on secondary share offering to raise cash. This dilution of stocks may make the valuation more unfavorable. All of the above factors are testing the rationality of the company's valuation. Of course, many companies use debt to fund development without any negative consequences. From the current situation, the company is at least not financially risky. Although the company is still at loss, in fact, it has generated a positive free cash flow of $560 million. So, the balance sheet looks pretty stable. In addition, the total liabilities and current assets are exactly the same. The company still has 6 billion in cash on the company's book, which is more than the current liabilities 4.6 billion. So don't worry too much about that. Analysts expect its annual revenue to grow by 91%. The adjusted net loss per share will narrow. These growth rates are still significant. Ultimately, the company's future profitability will depend on whether it can grow further in the long run. The latest drama may soon be included in the MSCI Singapore Index, which is widely expected to boost investment sentiment in Singapore's local market. The good news for shareholders is that its strong income growth makes it easier to raise funds when needed. But this does not change the view of the stock's risk. To sum up, this Southeast Asian technology giant is a growing company that has some concern that's going to be continued. Its e-commerce and game business performance in the post-pandemic era will increase the short-term fluctuation of this stock. The volatility is more attractive to swing traders. In terms of stock price of Sea Limited, that is a relatively strong support from $180 to $200. I personally think that the path of Sea Limited growth will be bumpy, so this stock is not suitable for everyone. If you don't like volatility, or if you don't have the ability to persist in those volatility for a long time, then give up this stock. If you have a certain amount of capital and a waiting period of 3 to 5 years, these growing tech giants will generate more income in the next 5 years, and people will reach the scale of experience. Its potential long-term returns are still greater than the near-term risk. From its execution and growth in the past, I have more confidence of this company. If there is mistakes and omission, you're welcome to criticize and correct. The viewpoint of view of all the video is just my personal risk. There are risks in the stock market, and you need to be cautious. This video is for educational purpose only. If you comment below about which ETF or stock you like to hear, remember to like, share and subscribe this channel. See you in the next video.